the daily edition of Market Wrap with Mo Ansari.
Brought to you by Compact Asset Management,
Providing proactive portfolio management and world-class wealth management solutions.
Hello, everyone, and welcome to Market Wrap. I'm Mo Ansari, president of Compact Asset Management, and you're tuned in as you've been doing so for 2 decades now. And as always, you can call in, and I will be more than happy to share with you my 33 years of trading experience. For the next few minutes, hold your calls. On our guest line is Dr. C. Fred Bergsten. He's the director of the Peterson Institute for International Economics. Dr. Bergsten was formerly Assistant Secretary for International Affairs of the U.S. Treasury, Undersecretary for Monetary Affairs representing the United States, and coordinated U.S. foreign economic policy in the White House as Assistant for International Economic Affairs to Dr. Henry Kissinger. Dr. Bergsten testifies frequently before Congress and appears on television. He has authored, co-authored, or edited 40 books on international economic issues. Dr. Bergsten, thank you for being with us today.
It's a pleasure to be with you.
Dr. Bergsten, is this the end of the euro, or do we think the euro will survive?
I think the euro clearly will survive. It may survive in a somewhat different form and even possibly with slightly different membership. But the experience of the European integration effort, going back really now over 50 years, is that when they have these crises, and they've had them many times, they tend to come out of it with new forward-leaning steps to enhance their economic union. The Europeans decided about 10 years ago to create what they called economic and monetary union.
Yes.
They did the monetary union, which is the euro, the currency. Mm-hmm. They did not do the economic union. They have no consistent economic policy, no consistent fiscal policy, no economic governance system. Mm-hmm. My guess is that out of this crisis, and with the bailout package as kind of a first installment, they will start moving toward completion of that economic integration and take forward steps, which over time will actually strengthen the underpinnings of the euro.
Dr. Bergsten, if we are going to have a stronger euro, that means some of these smaller countries will have to give up a lot of their control that they have over their economies. What they're going to have to do is hand it over to Germany and France, who will basically dictate to them what kind of deficits they can run, what kind of monetary policy, what kind of social policies they can run. Will they be willing to give up that kind of power to the stronger, bigger members of the EU?
They have already given up 2 of the usual central elements of national economic sovereignty. They have given up their ability to set a national monetary policy. Mm-hmm. They're now all part of the euro. They're part of the European Central Bank. They don't set interest rates. They don't set monetary money supply rates. They've already given that up. Second, they've given up the ability to set their own exchange rate. Again, as part of the Eurozone, they don't have an exchange rate for the Greek drachma or the Portuguese escudo. They are part of the Eurozone, so they cannot alter either their exchange rate or their interest rate. That's done for them by the central authorities. So, having given up those 2 major tools of national economic policy, the question is whether they would give up the others, budget policy, labor market policy, and all that. The problem with this halfway house they're in is that they don't have much ability to use purely national budget policy or other kinds of economic policy that would have much impact on their positions, having given up the monetary and exchange rate instruments in the first place. So it's actually primarily in the interest of the smaller European countries.
Dr. Bergsten, let's move forward a little bit. Let's talk about California, which people are saying is the next Greece. So we have policies here that are out of control. We are spending more than what we take in. So now will California have to give up some of its policies and give it up to the federal government, and the federal government will have to transfer monies to bail out California?
Well, as I said, the federal government is now transferring money to California. Now that California has become a deficit area with economic problems greater than the country as a whole, it is quietly, without any public attention or notice, getting transfers through the federal government from better off parts of the country. If California has higher unemployment than the country as a whole, it's getting a transfer of unemployment insurance payments.
Isn't that exactly what is happening in Europe right now, Dr. Burson, where they've decided to bail out Greece, and now we've got Portugal and Spain, which are next, and Ireland, and they're all getting in queue?
They're trying to, in the European case, they're actually trying to achieve the opposite. They're trying to build a firewall around Greece and the other problem countries by putting such a huge bailout fund in place that it will alleviate market psychology, fearing that any of those countries might default. Obviously, it has not worked completely yet. There's still pressures on the European markets and on their currency. But that's the idea. In the U.S., you could advocate something similar, but as I say, we already have a system that is generating substantial fiscal transfers to California.
Dr. Burson, let's move from Europe to Asia and take a quick look. We've got a few minutes left. The Secretary Geithner and Commerce Secretary Locke are preparing for a trip to China. Can you tell us a little bit about the purpose of this trip? And do you think they are going to be able to convince the Chinese to let the Chinese currency appreciate a little bit more or quite a bit more, as they have been asking, and be able to stop Congress from targeting or designating China a manipulator of their currency?
The purpose of the trip is to carry out a long-term process of increased consultation and hopefully policy cooperation between the two most important economies in the world, the United States and China. The process began under the Bush administration back in 2005. It's had different names, it's had different leaders, but it's now been going on for 5 years, and it's a very important structural element in these two key world economies coming to understand each other better, cooperate more closely, avoid blow-ups in the relationship between them. I think it's actually worked fairly well. China is running by far the world's largest trade surpluses. The U.S. is running by far the world's largest trade deficits. That could have led to some really very major conflicts well before now. And the fact that they've mainly managed those issues in a reasonably harmonious way, I think is a tribute to this intensified consultation that these strategic and economic dialogues, as they're now called, have personified. Mm-hmm. The U.S. does have very important asks that it is making of China in these talks. The currency is right at the top of the list. The Chinese have signaled over the last couple of months that they are prepared to let their currency start strengthening again. They did so for about 3 years, from 2005 to 2008. They stopped when the global crisis arose, fearing instability to their own economy. We don't expect them to correct that all in one fell swoop. That would be quite disturbing and discombobulating to their economy. The Congress will come back into the act. But Congress has been willing to sit aside. I testified to them on this a month ago for 3 hours, 35 members, House Ways and Means Committee. They are prepared to let the administration try this.
Dr. Burson, I want to thank you for taking the time out of your busy schedule and being with us today and giving us this overall perspective of where the international economics are headed from your perspective. Thank you again for being with us today on Market Wrap.
Good to talk. Bye-bye.
Bye now. That is Dr. Fred Bergsten. He's the director of the Peterson Institute for International Economics and is formerly the Assistant Secretary for International Affairs for the U.S. Treasury, Undersecretary for Monetary Affairs representing the United States, and coordinated U.S. foreign economic policy in the White House as Assistant for the International Economic Affairs.